Hi everyone, welcome to this episode of Rapid Fire Real Estate investing for busy people. Today we're talking about cash flow, specifically how we calculate cash flow. And this is part of our buy and hold strategy where we buy properties, we improve them, we rent them out, and we generate cash flow or profits per month that we put into our pocket, which we use for other investments. So here's how we calculate cash flow. We start off with the income. We start off with what the rents are per month, and sometimes in the ad for the property for sale, it'll say what the rents are. It might say what the current rents are, or it might say what they call pro forma rents are, or the anticipated rents. This is where we have our agent go ahead and call the seller agent and get the actual rents today. We also want to look at any laundry income that they may have. They might have a couple washing machines there and dryers. We also want to look at storage. Sometimes the current owner has a storage shed or a locker or a garage they use, and they actually charge their renters for that. So you want to know all those incomes that the current owner has in place. After that, you really want to look at the expenses. So we spend most of our time evaluating this, because if the ultimate cash flow does not work out, we don't even look at the property. We don't even go on there. We don't even schedule an appointment. We don't want to waste time and money and effort on something that's not going to cash flow. So this is where in expenses, this is where a lot of times if we miss something important and we find it out later, then the whole deal falls through. So you want to get it right in the beginning as much as you can. So for the expenses, you want to look at the utilities. We look at what utilities are being paid for by the landlord versus the tenant, and are they individually metered? If it's a multi-family unit, is the electricity individual, or how does that work currently? We want to look at things like vacancy, and you can look on your county website. Sometimes it'll have demographic information on the average vacancy in that area. We also look at things like repairs and maintenance. We get a best estimate on that, and alongside that, we look at what we call CapEx, or capital expenditures. Capital expenditures being the big ticket items that we'd have to pay for, like replacing a roof or doing some structural work or something like that, major landscaping, you name it. So the repairs and maintenance are more the day-to-day things, and the CapEx are the bigger items. So you want to take that into consideration when you're looking at your expenses. After that, we also look at certainly look at the property tax. We figure out what the property tax is most likely going to be for the whole year. We divide that by 12. That'll tell us what it breaks down to per month. Again, we start off on a monthly basis here. Property insurance, we do the same thing. We often try to get quotes early on to see what it would cost. And property management. Now that's key, because are you going to own the property and rent and manage it yourself, or are you going to own it and have someone else manage it? If that's the case, then that's an extra expense, and a lot of times we forget that could be 10% of your income. So you got to take all those into consideration. One note here is that if you are trying to get just a real quick and dirty cash flow number, and you don't have all of this information, maybe you don't have access to it, but you want to account for it. Sometimes we will just say, okay, look, let's just estimate that all the expenses are going to be 40% of what the income is. That's a very rough number, as you can see, but it at least takes into account the majority of the expenses. Of course, it's always better to actually have at least the closest number possible that you can find or estimate based on the resources you have. So this is where a lot of the homework comes in. to figure that out first. So once you have all your income for the month, you subtract all the expenses you anticipate for the month, then that gives you what's called your net operating income, or your NOI. These are all operating expenses. So your net operating income is how much you expect to have after your expenses, but before you've actually paid your mortgage yet. So the next step is your mortgage, the debt service, the amount that you're paying to your lender every month that you absolutely have to cover. You absolutely cannot default on that. So once you have the debt service number and how you can estimate that, well, the best thing is to, if you have a relationship with a banker, to kind of throw this at the banker and then see what they say, how much they think you'll have to pay for a debt service. But also there are mortgage calculators online, and there are mortgage calculators on apps. But you got to be careful with those too, because you got to make sure that the mortgage calculator that you're using, that you're putting the amortization correct, that whether you're looking at a commercial property versus a residential property, that could be quite different in the interest rate that you're going to have. So be careful using those calculators and those apps. Ideally, if you have a relationship with a banker, that would be the best thing, because then they take into account you as the borrower, as well as the property itself. Now, if you are getting a commercial property, then it tends to be more on the property than you. But that's a word of caution when it comes to estimating your debt service. So let's say you have a number for that. You take your net operating income and you subtract that monthly debt service, that monthly mortgage payment, and what you come up with is the cash flow. That's the cash flow for the month. So what makes cash flow really important is that if you take that monthly cash flow and you multiply it by 12, then that'll give you your annual cash flow. What you do is you take the annual cash flow, how much you're putting in your pocket per month, you divide that by the total amount that you put up in the beginning, which is your down payment, your closing costs, and any other expenses up front, like repairs that need to be done before you can rent the property the way you want to rent it. You take this annual cash flow, divide it by that capital outlay that you're going to put in the beginning, and what that turns out to is something called your return on investment, your ROI. This is the bottom line, is your ROI. It's telling you how well your investment is doing. It's telling you what you're making per month on the money that you put in the beginning. And probably more important for investors, it really tells you, it gives you an idea of comparatively how you're doing if you are going into this property as opposed to putting that same amount of money in a stock or something else. This is a key metric to compare opportunities, to compare your opportunity costs, and to tell you where you are on your investments, and if you need to shift your investments and pivot. You always want to look at your ROI, your return on investment. So that pretty much covers how we calculate our cash flow, so you can see why cash flow is so important. You want to see if you're even going to do the deal, and if you are going to do the deal, what is going to be your return on investment. So you're going to see examples of this when we do our deal reviews, and we're going to go over more topics like this in detail. If you like this type of content, go ahead and give us a like on this video. Also, feel free to give us a comment below on your experiences with cash flow, and how maybe you calculate a little bit different. Maybe you have some insight on how to do this your way, and how it's worked for you. We'd like to hear that as well in the comments below. And if you find value in this content, definitely subscribe to our channel so you can get more content like this on a regular basis, as well as actual deal reviews that we look at on a weekly basis. So we hope that this has given you some value, and we look forward to seeing you on the next video. Thanks for joining us.